Good afternoon. Welcome to the Monetary Policy Stance and Monetary Policy Report press briefing. Let us welcome the following BSP resource speakers: Monetary Board Chairman and Bangko Sentral ng Pilipinas Governor Felipe M. Medalla, Deputy Governor Francisco G. Daquila Jr. of the Monetary and Economic Sector, Senior Assistant Governor Iluminada T. Sicat of the Monetary Policy Subsector, and Officer in Charge Dennis D. Lapid of the Department of Economic Research. Governor Medalla will now deliver the statement on the monetary policy decision.
At its meeting on monetary policy today, the Monetary Board decided to raise the interest rate on the BSP's overnight reverse repurchase facility by 50 basis points to 6%, effective tomorrow, February 17, 2023. Accordingly, the interest rates on the overnight deposit and lending facilities will be set at 5.5% and 5.5% respectively. To 5.5% respectively. In deciding to raise the policy interest rate anew, the Monetary Board noted that the latest baseline inflation forecast, FAT, has shifted higher relative to the previous assessment. Average inflation is projected to reach the upper end of the 2 to 4% target range at 6.1% this year, 2023, before resuming to within target at 3.1% in 2024. The forecasts were adjusted upwards following the higher than reported inflation outturn in January, as well as the continued stronger rebound in domestic demand and gross domestic product GDP growth in the fourth quarter of 2022. Both headline and core inflation measures have also continued to increase, indicating a further broadening of price pressures, particularly in services. Meanwhile, inflation expectations have likewise risen further, underscoring the need to preempt the emergence of further second-round effects. At the same time, the balance of the risk to the inflation forecast now leans towards the upside for both 2023 and 2024. With pressure emanating from the potential impact of global food market uncertainties, continued domestic shortages in key food items, additional transport fare hikes amid elevated oil prices, and the higher than expected wage adjustments in 2023. Meanwhile, the impact of a weaker than expected global economic recovery remains the primary downside risk to the inflation outlook. The Monetary Board reiterates its encouragement and support for timely and more aggressive whole-of-government actions to mitigate the impact of persistent supply-side pressures on food prices, including trade-positive measures and significant progress to boost productivity. Given these considerations, the Monetary Board deems a strong follow-through through monetary policy response as a necessary response to reduce the risk of a breach in the inflation target in 2024. An upward adjustment of the policy rate, interest rate, would also prevent inflation expectations from drifting further away from the target band. The Monetary Board also believes that with domestic growth exceeding expectations in 2022, monetary action can help to dampen potential demand-side pressures and second-round effects without unduly hindering the sustained momentum of economic growth. The BSP reassures the public that it stands ready to take all necessary policy action to bring inflation to within the 2 to 4% government target over the medium term, in line with its primary mandate of ensuring price stability.
Thank you, Governor. At this point, we would like to request OIC Lapid to share with us the February 2023 Monetary Policy Report.
Thank you, Alicia. Good afternoon. So this is a short presentation summarizing the key considerations that went into the Monetary Board's latest monetary policy decision this morning. A more detailed discussion of these various factors can be found in the Monetary Policy Report for February 2023, which will be published tomorrow on the BSP's website. First, in deciding to raise again the policy interest rate, the Monetary Board considered the following factors. As always, we are guided by the outlook for inflation. The latest baseline inflation forecasts have been revised further upwards, as noted by the governor earlier, with inflation now settling above the government's target of 2 to 4%, that's 6.1% for 2023, and slowing down to 3.1% for 2024. Inflation is projected to remain elevated over the next few months until early in the fourth quarter of this year. The latest baseline forecasts indicate that inflation will likely average at 7.7% in the first half of this year, before decelerating to 5.4% in the third quarter, and then further on to 3.8% by the fourth quarter. Inflation is projected to decelerate up after that to close to the lower end of the 2 to 4% target by early next year. And this will be mainly because of the dissipation or the abatement of supply side pressures on oil and non-oil commodities, as well as some negative base effects that will be in effect. In terms of the risk, in the next slide, the Monetary Board considered the following risks to the inflation outlook. Firstly, in terms of the balance of risk, the most of the risks are now weighted towards the upside for both 2023 and 2024. So on the left-hand part of the slide, you'll see a listing of various factors that could constitute upside and downside risk to the central or baseline inflation projection. So firstly, on the upside risks, these are the factors that could push actual inflation higher than the baseline projection. So these are, on the external front, the potential impact of high input prices, particularly fertilizer prices, and adverse weather conditions on global food prices. On the domestic front, we considered increased prices of key food items that are facing supply constraints, such as sugar, livestock, poultry, fish, onions, and potatoes. The Monetary Board also discussed the possibility of additional transport fare hikes due to elevated oil prices and potentially higher than expected wage adjustments in response to inflation. Meanwhile, in terms of the downside risk, the main factor discussed by the Monetary Board is the possibility or the risk of lower world GDP growth, pulling down actual inflation below the baseline forecast. For this particular downside risk, where the staff and the Monetary Board agreed that this is a low probability factor, given that most of the information regarding the strength of world GDP growth has already been factored into the baseline projection. In terms of the probability distribution, you'll see on the upper right hand part of the slide. Here we try to show that the forecast or the probability of where actual inflation will land is skewed to the upside. And this is reflected in the high probability. If you look at the last column, where it was for 2023, we show a 96.7 probability that inflation will be higher than 4%. So that's based on our reckoning of where inflation will likely end up. Versus, in contrast, the assigned probability to inflation being within the 2 to 4% target as of Feb 2023 is only 3.3%. And at the same time, we have a slightly higher probability of inflation staying within the 2 to 4% target next year in 2024, 53.1%. The lower right-hand table shows the 80 and 90% confidence intervals of our forecasts for inflation. The next slide just shows you graphically what we mean in terms of the outlook. As you've probably seen similar charts in the past, this essentially traces a downward path for inflation over the policy horizon. So that in this chart in particular, the blue, different colored blue bands are around the central dark line represent the various probability intervals around the central projection. And here with the blue bands are shown to be slightly thicker on the upper part of the graph. And that's meant to depict that the risks are mostly on the upside, both for this year and for next year. Next, the other factors examined by the Monetary Board today are inflation expectations. So this shows the latest survey conducted by the BSP of professional forecasters. So analysts and economists have provided us their latest forecast for 2023 inflation up to 2025, incorporating the latest information from the January CPI release. So we surveyed 24 private sector economists this February, and the mean forecast that we received from these respondents was 6%. So this is higher compared to only 4.9% when we did the January round of the survey. Similarly, for 2024, the mean inflation forecast is also higher at 4% from 3.7%. And for 2025, the mean forecast of 4.1% is higher than 3.6% back in January. In the responses, the analysts said that they expected inflation to breach the upper end of the government's target range for this year, given the higher than expected January CPI inflation print, as well as demand side pressures and also supply shocks continuing to influence inflation in the short term. Similar to the BSP, respondents also see the risk to the inflation outlook as remaining tilted to the upside due to the continued recovery of domestic demand alongside high prices of goods and services as a result of supply-related concerns and second-round effects. At the same time, analysts also expect that the monetary tightening by the BSP will help to bring down inflation, especially in the second half of 2023. Other factors discussed include core inflation, which the CPSA core inflation measure takes out selected food and energy prices from the main CPI basket. The latest figure is for January at 7.4%, so that's a further increase from 6.9% back in December. And this, to us, suggests a further spillover and also a further emergence of second-round effects from ongoing supply shocks. The rise in official core inflation was due in part to sharply higher prices for large weight items such as housing, water, electricity, gas, and other fuels, and also food and non-alcoholic beverages. In addition to restaurants and accommodation services. And the last one in particular, restaurants, has been, we observed to be partly being driven by some of the revenge spending or stronger demand in the fourth quarter. In the slide, we'll also see the other measures that we calculate for core inflation. These are computed by the BSP. So we have a trimmed mean, weighted median, and principal components core inflation rates, and these are similarly much higher in the most recent January data. Other considerations include, so the Monetary Board also took note of the continued recovery in domestic demand, output growth, GDP growth in the fourth quarter was stronger than expected. And this was also a factor in the revised forecast. This was supported by strong domestic demand, particularly, as we said, revenge spending and holiday spending in the fourth quarter. The reopening of schools with the resumption of face-to-face classes, increased tourist arrivals, and also improvements in labor market conditions. So the economy grew by 7.2% in fourth quarter based on GDP, and this exceeded most forecasts from the private sector. A full year growth for 2022 was 7.6%, and which is higher than the 6.5% to 7.5% DBCC target for the year. So the key reason, of course, is pent-up demand and also holiday spending that helped to drive up household spending on restaurants and services. In addition, exports of services also remained at double-digit rates, supported by travel and other activities which benefited from the further reopening of the economy. In terms of domestic demand, we noted that the sum of private consumption, investment, and government spending together increased by 6.4% during the fourth quarter. In terms of the outlook, GDP is projected to settle within the DBCC 6 to 7% target for this year. But economic headwinds could result in slower GDP growth in 2024. The full year growth forecast of the BSP for 2023 has been adjusted upwards from our previous monetary policy report to take into consideration the Q4 GDP data. The growth forecast for 2024, however, is lower compared to the previous round, and this mainly reflects the weaker global economic prospects and also the impact of the cumulative tightening that's been undertaken by the BSP so far. In addition, domestic activity the Monetary Board noted that domestic economic activity has rebounded past its pre-pandemic levels, with the economy seen to operate broadly within or in line with potential growth. Staff estimates indicate that the output gap is likely to be slightly positive in the early part of this year, and this reflects the sustained economic expansion that we've seen based on in the last few quarters in 2022. Thereafter, the output gap is seen to remain in broadly neutral territory or small positive number as the impact of policy rate adjustments by the BSP takes hold on the economy. So to summarize, in view of these different factors and conditions that were discussed, the Monetary Board decided to raise the overnight RRP rate by 50 basis points to 6%, effective on Friday, February 17. The new information that's become available since the previous monetary policy meeting in December argued for maintaining the BSP tightening bias and also reinforcing its anti-inflation commitment. The main priority for the BSP is to guide and also prevent unfavorable shifts in the public's inflation expectations, which will also temper the emergence of further second-round effects down the line. Broader inflation pressures, as indicated by rising core inflation and higher inflation expectations, constitute the main reason for follow-through a strong monetary action. The higher near-term growth path for GDP also suggests that the economy as a whole will be able to sustain its recovery momentum even with higher interest rates. Lastly, continued monetary tightening will also provide a buffer against external spillovers that could come from the continued tightening of global financial conditions as major central banks such as the US Fed continue to raise their interest rates even further. So I'll stop here. Thank you very much.
Thank you, Sir Dennis. We will now proceed to the questions from the press and market analysts. For additional questions, you may send your comments through this live Facebook broadcast or messages through text, Viber, or Messenger. We will follow this order for the questions. First, questions from in-person attendees. Next, questions that have been sent in advance. And then third, questions from our Zoom or online. Thank you. Are there any questions from the floor?
Hello, good morning. Good afternoon, rather. Warren de Guzman, ABS-CBN. I just wanted to ask, when was the last time the benchmark rate was this high?
Tagal na. 2007, I think. I think it's 2007.
And regarding the policy statement, you mentioned that a strong follow-through, considering that you raised the inflation outlook to 6.1% for this year. Is that an indication that we might see more rate hikes moving forward?
Yes, in other words, anything is possible, and the least likely scenario is no increase in the next meeting. We cannot rule out anything, but if I were to say which is the least likely scenario, it's zero in the next meeting. Of course, if a negative shock happens, reversing all of this quickly, then I might be wrong. Okay. The point is just a few items account for a huge amount of increases. Fish, sabi ko nga talagang prutas, karne, isda, gulay. And then, of course, liquid fuels. All those together alone is 0.46%, which means if you were to annualize that, of course, that's a lot. Unfortunately, that's not our scenario. But as you can see, and then the fact that the economy was actually stronger than we expected meant higher increases in rental rates. As you know, most lease contracts get renewed at the beginning of the year. And also significant increases in restaurant prices, which again are due to the fact that the economy is really more open now and stronger. So it's a combination of two things. The fact that we're surprised with the growth, as everyone was, plus the fact that somewhat small items to get taken together was large. Indeed, I had remarked in a monetary board meeting that this is unusual. In the past, major items account for the large inflation, like rice, fuel, electricity. But this time, it's fish, meat, eggs, vegetables, and fruits. Now, in the case of meat, of course, it's the lingering effects of the Asian swine flu. And so these are largely supply shocks, but there is also a demand side for it, which is the rentals and the restaurant prices. So we have to have a very vigilant stance, which we, of course, are completely data dependent, but given my own experience in the past, it's something like this. It's unlikely that we will not increase the rate next meeting.
Governor, I just want to answer the first question, specifically on the period where we had a 6%. It was in August 2008.
2008. So 2007, yeah.
There was also in 2010, but the most recent before this is August 2008.
And of course, it did surprise us. As you can see, the actual inflation was outside our range. What was our forecast? 7.9. I think at the midpoint of our forecast was more like 7.9. So that's almost a almost a 1 full percentage of rise.
Thank you, Governor. We will proceed to the next question. Please identify yourself and your organization. Thank you.
Good afternoon, Governor. My name is Karen from Reuters. Hi,
Hi,
sir.
Karen.
Hi, sir. How are you? Sir, so you just said that it's unlikely that the central bank will not raise rates at its next meeting, given as you have described the surprise inflation rate in January. And you also said a while ago that it is possible that there could be more rate hikes ahead, which differs from what you said before the January inflation was released, where you said that it's possible 2 more rate hikes in the first quarter. So given that that's the projection you're looking at, how will this impact now your growth assumption for the year when you're expecting further tightening and at the same time higher inflation forecast, which is 6%, which is way higher than your original estimate?
Okay, actually, since I did not want to preempt other board members, my own view, now I can tell you, was 225s.
Okay.
I think that's off the table.
Okay.
Now, on the other hand, what could make us reverse this direction that we're taking? What is, if month-on-month inflation is negative this month, which requires that the import relaxing measures are taking effect. I don't really know how quickly that will happen. Like now they're saying they're going to import 500 metric tons of sugar. So if the scenario where you have a very fast impact of the relaxation of imports happens, then that will mean that we will not be as aggressive. But on the other side, it takes long for those goods to reach us, right? It takes long to order them. It takes long to the decision itself to actually do it will also take long. That's why I give a fairly low probability to. In other words, with this new information means tighter monetary policy.
Yes. Impact on growth.
Impact on the growth, fortunately, the economy is quite strong. And maybe we all underestimated pent-up demand. So we think, and also in real terms, even assuming that our forecast that by now our new forecast that before the end of the year-on-year inflation, that is the headline inflation, will be below 4 before the end of the year. Even if that happens, in real terms, the policy rate is just 2%. Right? So in that sense, relative to even if you believe that the central bank cannot make a mistake, it's still quite the policy rate is not as restrictive when viewed in real terms rather than in nominal terms. Now, if you believe that we are wrong on the low side, then all the more that you think that the policy rate is still quite high. Okay, so to begin with, even without this, what's our finding? Every 50 basis points is just a 0.1% on growth. Yeah. It's hard to remember all these numbers, but what I know is that a rate hike will just cut growth by 0.04% GDP.
Thank you, Governor. Are there any more questions? We have a question on the side.
By the way, that's a 50 basis point rate hike, not 25, right?
Hi, Gov. Ditas Lopez from Bloomberg News. Gov, given the latest developments, is a rate hike pause feasible in the first half? Thank you.
It's feasible, but I would say, though, that in the first quarter, it's almost like betting on which number will come out from 1 to 20 and you get it right. right? So I think, of course, if you take a longer view, which is the entire second half, so many things can still happen, which could result in a much better inflation picture and probably a downward revision of our forecast, but not in the remaining months of the days of the first quarter. So that's just 2 months and a half left, right? Because remember, the import relaxing policies will take time before it becomes actual supply. Now, listening to Secretary Diokno and Secretary Malisacan, I'm quite optimistic that the best short-run response to temporary supply is importation, right? So I think both Secretary Malisacan and Secretary Diokno will, of course, be arguing very hard for that kind of response. And I think they will be able to deliver for the sake of low inflation.
Thank you, Governor. Any more questions? Follow-up question.
Well, just a clarification from your earlier comments. So every 50 basis point increase in the rate hike can cut growth by
0.04%.
0.04%. That's pretty small.
Of course, that's our model, right? And usually models with margins of error. Okay, so it could be that 0.04 is really 0.02 to 0.06, let's say 0.07.
Thank you, Gov. We have another question.
Good afternoon, Go. This is Keisha from Business World. With the higher inflation outlook for this year, when do you see inflation peaking po? And for Ma'am Sikat, what was the benchmark rate back in August 2007?
Well, so I've been burned before, so I'm not going to try again. Okay, so I thought January was the peak. So, but what we know, and this is where I'm confident given our record, although this is a particularly bad period, in the past, 15 straight months of above target inflation is about the longest. Now we're saying, well, maybe it's 19, 20, 21 months. But again, the very nature of the risks, for instance, if you try to make an inflation forecast and then fit it to the data, you will find that the further away you are from the starting point, the bigger the errors. The simple reason for that is the greater the amount of time, the greater the number of unpredictable shocks that could happen. A good example is predicting when that light bulb will go off. If you ask me about the next 10 seconds, I'll say 100% that it will not happen. But then the longer the period, the more the error is, right? If it's, when will it go out exactly during the next 10 years? That's a very hard thing to forecast. It's very, very similar for things that are covered by random shocks. The random shocks happen. And sometimes historical experience is not helpful because there are new shocks. Like as I was saying, in the past, we always said rice, fuels. If you had asked me many years ago whether the vegetables, fruits, and juices will be a major source, I would have said unlikely, but that's exactly what happened now.
Thank you, Governor.
Governor, just to respond to the question, the 6% in 2007 happened in July 2007, but the difference then is that the 6% in July of 2007 was actually a reduction from 7.5%. So condition then was different as compared to today. In 2008, there was an increase in policy rate from 5.75 to 6%. So if you compare the two, the difference in the inflation trend then in 2008 is somewhat similar today because of the increase in inflation rate.
Of course, if you take the view of 7-month view, this is very high because we started from 2%. But you also have to remember that the 2% was also abnormally low because it was a response to the pandemic. Indeed, even if these things did not happen, we already had an exit plan. And the exit plan was a gradual lift up because we thought the monetary policy to help the economy was already be working and we would need a gradual lift off. Well, to say the least, the actual lift off was a lot faster than we were anticipating when we were talking about the exit plan. We had an exit plan, and it turns out the actual exit was much faster.
Thank you, Gov. Thank you, Ma'am Lu. We have another question from Jerome.
Hi, Governor. Good afternoon. Jerome Morales here from Reuters. Gov, you were mentioning pause is unlikely, at least in the first quarter. And so in terms of magnitude of future rate hikes, how do we see the future rate hikes? Do we see another supersize? Do we see more gradual like what you have planned before?
Again, it's very hard to say. But personally, I don't think we need to resort to 75s unless the Fed does the same thing. You know? So right now it's a my own personal view. Because exactly how events will play out, of course, is very hard to guess. But if I were to make a choice and forced to make a choice, I would say I'll rule out 0 and I'll rule out 75. Of course, as I said, the events eventually could lead to something lower or higher. But right now, that's my assessment. The need for extraordinarily high interest rate increases like 75 was largely because the inflation was also coming with a very weak and rapidly depreciating peso. I mean, I think there was a time in a very, very short period, the peso depreciated by 14%. So unless there's again another large change in monetary policy somewhere else, I think we have done enough 75s.
Thank you, Governor. We will now move on to questions that have been sent to us in advance. The first question comes from Emmanuel Lopez of the Colegio de San Juan de Letran. He asks, the expected increase in policy rates is largely because of the continued increase in prices, which resulted in the 8.7% inflation, the highest in 14 years. However, the value of the peso vis-a-vis the US dollar shows relative strength despite the high inflation. Does this mean that the peso is overvalued and therefore not free floating?
Okay, there are 2 points. Is it overvalued or is it not free floating? Okay, all I can say is that what this proves is there really is very weak link between changes in the exchange rate and changes in the inflation rate. In fact, this is one of the wonderful benefits from our movement towards inflation targeting. Meaning changes in the exchange rate change the relative prices, not absolute prices, which is why it works. It does not cause higher inflation. It makes people, when peso is depreciating, say, oh, hey, I want to buy less imported goods and shift to domestic goods. So it works. Now, however, the findings all over the world is if the inflation is one way and large, that relationship no longer holds. Okay, so the practical side of it is that prices, it's also costly to change prices. If you have customers, you change prices, you spoil relationships. So if you know the exchange rate can go back and forth, you will keep your price rather than adjust it. Now, as to, okay, so in other words, credible inflation targeting, not just in the Philippines, but in Thailand as well, has resulted in very low translation of exchange rate changes to inflation, as low as but a translation multiplier of just 0.04, 0.06. I remember in a seminar, I said, oh, Philippines, no translation. And then the speaker from Thailand said, well, ours is half yours. Okay, so the other one is the peso not freely floating. Well, to the extent that we participate in the forex markets, and in some cases intervene because the volume is too small, too large to be considered just participation, then it's not. But at the same time, all we do is prevent overshooting. The problem with not interfering is the markets have the tendency to overshoot. Let's say the correct fundamental is a X, but then the market can go X plus 5, X plus 4, right? Or the other way around, X, then the market can go X. So the tendency of markets to overshoot justifies intervention. Because then in the long run, though, we do not. For instance, if you allow the peso to move to 48, appreciate to 46, then the likelihood that there will be a large depreciation later on is higher. So it swings. So what we're doing is controlling the swings, not really fundamentally changing its value. Now, what is the downside to it? The downside to it is people who borrow in dollars don't have peso revenues, because they think that the central bank will minimize the swing, then he might consider it less risky. So that's one unintended effect. But if you do allow significant changes, then you get but manage to really get rid of very excessive changes. You manage to get the best of both worlds. Now, that's why sometimes, what exactly is the level where you should intervene? Is there a magic number? Usually the answer is no magic number. Let's say no such thing that if the exchange rate hits this level, we're going to intervene. So it's done really in a day-to-day basis. I get advice from our people. Hey, at this point we will participate and sell, and so on and so forth. Okay, so by and large, it has resulted in periods where we accumulate reserves and periods where we reduce our reserves. But it's not one way.
Governor, just to quickly add, on the question of the overvaluation, the recent strengthening of the peso is also, I think, much more understandable if you consider the fact that empirically, currency movements in emerging economies are very strongly influenced by monetary policy and advanced economies, and particularly the U.S. So the recent strength of the peso, along with other emerging market currencies, also reflects the fact that the U.S. has begun signaling that it may slow down the pace of its tightening.
Thank you, Governor. Thank you, Sir Dennis. We will now move on to the next set of questions. Sir Michael Ricafort of RCBC sent two, but his first question was already answered, and this was about the peak local policy rate or the terminal rate. So we'll go to his next question. Could there be any changes in the estimate for the planned RRR cut or cuts?
Okay, actually, we really want to cut the policy rate. And in fact, we think that there's a way of cutting it that will not affect monetary policy, which is we increase our borrowings to offset the effects on money supply of the capital reserve requirement. The problem is that will confuse markets. So it's really good to then do one thing at a time, especially the things you're doing together tend to confuse. So that's the basic reason we're reluctant to increase. So we have this very, very strong commitment to want to do it for very, very simple reason. The last thing we want is people to move to financial intermediation that have much lower, that have no reserve requirements. You don't want to make the people, the institutions that we regulate be handicapped. So, but personally, I still think that given what will happen, I still think that cutting policy rates before the end of June is still feasible. Cutting reserve requirements is still feasible before the end of the first semester. But again, that I could not say with certainty. Okay, for instance, if we are already sure that we have done the last policy rate increase, just a few months after that's a good time to cut.
Thank you, Governor. Our next question comes from Lee Chipongyan of Manila Bulletin. She also asked about the peak inflation.
Yeah.
And she would like to know when we see inflation dropping to 4% this year.
Well, our own forecast is by the way, our early forecast is by the third quarter. It will cross 4. Now it will cross it by November or December, Francis, right?
That's correct, Governor.
Yeah. So again, if there are major changes, of course, that forecast could be low. By the way, if you're just looking at inflation being off target, regardless of higher or lower, the longest period is almost 2 years. But that was when inflation was below 2%. There were 2 years when the first year the inflation was 0.7, the second year the inflation was 1.6. So as you can see, if you look at the experience of shocks on the low side, we already know that it could be as long. Of course, the big difference is we are not as in a hurry to reply to the supply shocks if they are good. So maybe we will not hit the same number of months when the targets are being missed on the high side. That's why currently our target is the way we look at our forecast is 18, 19, or maybe 20 months of being above target, which will be a record since we did inflation targeting.
Thank you, Governor. This is the last question for this batch from Lee Chipongyan of Manila Bulletin. Governor Mindalia, you've communicated 2 rate hikes in Q1. Will January surprise inflation? With January surprise inflation, will there be more rate hikes in Q2 as early as May 18? Or are the 2 rate hikes enough to bring inflation to within target by the third quarter of 2023?
Well, the main scenario is that in fact, as I said, I started out with 225s. Now, really, that's wrong kasi 50 na agad yung una eh. So in short, it's hard to roll out a third after this one, or maybe even a fourth. But then that will be purely data independent. Although again, if we were to look at our history, when was the last time we had a policy rate of 6.5 or 7? Medyo matagal na yun, ano?
That would also be in 2007.
2007, yeah. So So it's not easy to say, okay, I guarantee this. We just think it's what's likely rather than what's sure to happen. This is very humbling, actually. That we were all thinking it's going to be a 7.9 or 8. It ends up 8.7.
Thank you, Governor. We will now move on to the questions that have been sent to us by our Zoom participants, as well as those who sent us questions online. So first question, we have actually two related questions. First, from Mr. Sanjay Mathur of ANC. Sir, can you please shed some light on the transmission of policy tightening, whether the lack of it is the reason for sticky inflation? And then a related question from Christopher San Pedro from our Facebook live broadcast. Do you have any estimates on the lag effect of the monetary policy in our inflation targeting policy? How many months should we expect the monetary policy to take effect and cool down inflation?
Okay, one thing you learn from Milton Friedman is the lag itself is variable. But if the lag is fixed, then forecasting things will be easy. Okay, the lag itself is variable. Now, the second part of the question, I think the best person to answer that is Francis.
Thank you, Governor. If I may cite some estimates of the sensitivity of inflation to
Policy rates.
policy rate hike. So with a 50 basis point hike this February, we're looking at inflation in 2023 to go down by about 10 basis points. And then in 2024, there will be a further 14 basis point decline in inflation. So that gives you an idea of the length of time it takes. Because inflation has to respond first to changes in demand. So the transmission is for a policy rate adjustment influencing the different components of demand, and from then that works its way to prices.
Yeah. But again, what you're afraid of is very sticky wages. And, in which case the scary scenario, since a small interest rate changes will not make large effects, is you need very large changes in the large and prolonged high interest rates. And this resulted in the invention of the word stagflation. What we learn from that is the moment inflationary expectations become very high and entrenched, it takes a recession to get rid of it. And they even came up with a term which is associated with the the chair of the Federal Reserve there, which is that credibility requires very large action. And then you end up with very, very costly trade-offs between growth and inflation. We are not there yet. We are not there yet. The reasoning being becomes the inflationary expectations causes wages to rise. And in turn, the wage rises cause price to rise, which in turn cause wages to rise. So therefore, the only way to stop and break that cycle is have significant unemployment. And that's the reason we should fight inflation before it gets really entrenched. We're not there yet. We have sufficient wage flexibility. And I think our system of wage fixing, which is regional rather than national, makes all the regions more moderate and be reasonable in their wage increases. I think the Philippine institution letting regional wage boards set the wages adjustment is a good one. So these are other findings relative to the time when national wages were set, where the wages were set nationally and by Congress at that. Okay, so we have learned a lot of things, and I think of course, it takes time for monetary policy to work. And the other frustrating thing is there are times when supply shocks actually overwhelm the effect of monetary policy, but they do work. But it does require patience and credibility, which we think, despite the fact that inflation expectations are a bit higher than ours, which I think requires credibility. And I'm proud to say, though I've not been a member of Central Bank board during that time, I would like to say that the Philippine experience with inflation targeting has been steady and build up of its credibility as an inflation targeting central bank. That's very precious to us. Yeah, that's a hard-won credibility, and we will not waste the efforts that were exerted to achieve it.
Thank you, Governor. Thank you, DG. Next question from Mr. Jonathan Ko of Standard Chartered Bank. In the new 6.1 inflation forecast for 2023, is the expectation that food prices will remain high and that supply bottlenecks that have caused a surge in prices in recent months are expected to remain through the rest of the year? What is the central bank's expectation of the effectiveness of non-monetary measures?
Francis, maybe you better answer that.
Thank you, Governor. Actually, the baseline forecast already assumes some normalization in food prices. We also have a scenario of what would happen if food prices were to continue to become elevated until the end of the year. If, for example, you have prices of livestock, poultry, fish, onions, and potatoes remaining elevated until end 2023, then that will lead to an increase in the 2023 projected inflation by about 21 basis points. So that's an illustration of how sensitive the inflation path would be to further supply side shocks. So as the governor has mentioned earlier, we're looking at the inflation path going back to within the target range by around October of this year. But it's possible that with the supply shocks, then that path could change. And of course, in order to guard against the risk that the inflation could even spill further on to next year, then that's the time that the monetary board will have to take this into account in deciding what further actions to take.
Well, the other way to look at it is there are limits to its scarcity of things could result in higher prices. At a certain point, you stop buying those things. So in that sense, supply shocks are self-limiting. And as Friedman famously said, is inflation always and everywhere is a monetary phenomenon. But he should have said persistent and high inflation is always and everywhere a monetary phenomenon. All that says in plain arithmetic is if all size, so if macroeconomic and fiscal policy are not the source of inflation, then they are like fires that will burn out when the fuel runs out. But if the fuel is monetary policy and the fuel keeps getting replaced, the fire will never end. So the simple arithmetic is, let's have suppose this is the most ideal situation, no second order effect, because inflation expectations are firmly implanted. Suppose you have an economy with zero inflation, so the price index is always 1. And you compute inflation, 1 minus 1 divided by 1, 0. Suppose that you have a large shock, 10%. But everybody believes that's the last shock. And everybody believes, as anchored, that from now on, that's the last shock, no more second order effects. Then it will be 1.1 next month, the second month, the third month, the 12th month, the 30th month, right? So all of those, the inflation rate is 1.1 minus 1 divided by 10%. But note what happens on the 4th and the 30th month. 1.1 is still the price index. But the price index 12 months ago is 1.1. So it's now 1.1 minus 1.1 divided by 1.1. So as soon as the base effect takes over, then it's gone. But the important assumption is no second order effects. We know there will be. And this is the reason we have to be tighter during the period. Now, it cannot be totally avoided that the pass on is gradual. For instance, we noticed that the price of services lag behind because it takes time before wages are adjusted. You know? So that's why we always look at what's happening to services. If we begin to see services also rising, then it means that inflation is beginning to spread to other parts of the economy. And that's the reason, like it or not, why we have to react, even if the inflation is supply side. No, very few cases where you will have zero second order effect, even if there is no action of the central bank. Okay, just because the central bank says, "Oh, it's supply side, we're not responding," that's not gonna cut it. If the supply shocks are large enough, the central bank has to act. Okay, because then that's the best way to make sure that the second order effects are prevented from getting out of hand.
Thank you, Governor. We have 3 more questions. So if I could please request for short responses, very short responses for each of them. First question comes from Mr. Mapa, Nicolas Mapa of ING. He asks, what is your new inflation, with your new inflation forecast, what is the BSP's new terminal rate?
Again, too hard to answer that question. I have my own personal view, but I think it will just confuse. I say so.
Thank you, Governor. Next question from Eileen Mencias of Abante Billionario. This is her question. Do you regret not having raised the rates earlier?
By the way, we already the most aggressive central bank in the region. And we acted on the basis of our forecast. So in that sense, there's really no point being engaged in regrets. We acted on the basis of information we had and our forecast based on this information. It turns out we are wrong. And now we have to increase policy rate more than we expected.
Thank you very much for all of the questions that you sent. This is all the time that we have for them. We will respond to the last question from Lee separately. We would like to thank everyone for their time and attention in joining this FB Live broadcast. And also, we would like to remind everyone that the Monetary Policy Report will be available on the BSP website tomorrow, February 17, 2023. This ends our press briefing. Maraming salamat po sa inyong lahat.